All right. Well, what is up, tycoons? What's up, traders? Super excited for today's video. Tons of good stuff to talk about. All right, we're going to talk about some inflation things. We're also going to go over the earnings surprise that you may not be expecting. Okay, I know lots of time people talk about earnings shocks. There's some really good data out there. All right, we're going to review a bunch of data. I want to start off here talking about the Nasdaq 100. All right, it is being rebalanced. Okay, now and that's going to be effective July 24th of 2023. Right? And they're going to address overconcentration in the index by redistributing the weights. A special rebalance will not result in the removal or addition of any securities. Now, if we dive a little bit more into that, all right, the rebalancing changes will be announced on the 14th, and they're going to take effect before the market opens on July 24th. So you want to keep an eye on ETFs like QQQ, QQQM, all right, you also have TQQQ and SQQQ, right? Those are some of the other ones. But unlike a reconstitution where stocks are removed or added, a rebalancing changed the weights of an index and their stock component percentages. The Nasdaq has only conducted a special rebalance twice in the past, in December 1998 and May of 2011. The rule states that the action will be taken if the aggregate total of all stocks with individual weights above 4.5 in the index exceeds 48%. Now, currently, the Magnificent Seven stocks account for 55% of the total weighting of the NASDAQ 100. And so right here, you can take a look at the Magnificent Seven. You have Microsoft actually exceeded Apple here. Then you have NVIDIA, Amazon, Tesla, Meta, and then Alphabet, right? So, this is why they are doing this special rebalancing in the NASDAQ, and this is going to affect some of these stocks, and this is just something you want to be aware of heading into the short-term future. Now, today's video is sponsored by Simply Wall Street. If you don't know how to do fundamental analysis or you're not a pro at it, they have their pros doing the fundamental analysis for you guys. It's a really great platform. You can get a 14-day free trial using the link in the description, right? And up to 40% off for your purchase for the first 100 people that join. It's a really amazing platform. It's also very affordable, especially with that discount. And what I want you guys to do is look up a stock that you really want to buy, or look up some stocks that you currently own and see potentially if they're overvalued or undervalued. They do a really good job of making things very simple, looking at price to earnings ratio, price to sales ratio. They look at the balance sheets and things like that for you. Definitely recommend it for you guys. You can also email me at any time for a one-on-one personal session, all right, with zachleytrades@gmail.com. We can work on scheduling a time together. As always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Now, let's get into it. Please be sure to read through the full disclaimer. Now, if we take a look here, the S&P 500 top 12 years, big up first half. And you can see here, whenever we have these really amazing first half returns, right, the data is actually a little bit skewed. Okay, the mean says that we're up in the second half 1.8%, and the median says we're down 1.8%. Right now, what I want to highlight in here is the time period. Okay, so relative to time, you can see back in the 30s up into the 80s. That's when we really got that negative second half return in the stock market. Okay. But if we take a look at some of the more recent data since the late 90s up until now, right, there's only been one time right here in 1986 where the market posted a really strong first half and did not post good second half returns. So, if you wanted to use this data, that's the way that I would look at it. Okay, is that more recently, okay, the second half has been a strong second half return, and so it's very possible we could see that again. All right. That's just kind of some of the more macro things and seasonal things and cyclical things that I'm looking at right now in the market to help guide me for the rest of the year. Now, bears have been unwinding equity bets. I pointed out in a previous video that we saw record numbers of shorts on the S&P 500 futures. This is the E-mini S&P 500 futures positions. We saw record numbers of shorts, and we've been seeing those shorts get squeezed out, right? They're covering, okay? We're seeing lots of shorts covering here heading into earnings season. All right, and this has been a really strong component of the rally here recently. Now, there's also BTFP, which a lot of people call this buy the Fed pivot. But what this is this is actually a bank term funding program. All right, and the one thing that I want to highlight to people, if I've pointed it out before in previous videos, but when you see the Fed balance sheet going up, okay, the stock market usually follows the Fed balance sheet. The reason being is if the Fed and the government really is stimulating the economy and putting money out there, that money oftentimes finds its ways into the equity markets. And ever since the bank collapse, right here in March, we've seen a strong increase, okay, in the inflows. All right. And basically, money just going out into the economy. And what have we seen? We've seen the stock market has actually been performing very strong since those bank collapses there in March. So that's something you definitely want to pay attention to is the Fed balance sheet and, what kind of, stimulus is the Fed really doing to the country and to the economy, has a very big impact on the stock market. Where they've been doing quantitative tightening, but they're doing quantitative tightening while also the BTFP. So I mean, they've pretty much erased all of the quantitative tightening that they were doing, and the Fed balance sheet is almost back at its peak again. So we'll go ahead and move on from here. And speaking about earnings, right? The macro data generally points to a beat right now. Okay. And if you take a look at the economic surprise index and then the aggregate EPS beat, right? You can see that once this thing starts to shoot up, all right. It's not uncommon for us to get an aggregate earnings per share beat. Okay. And you can see right here, that's kind of what it's implying right now at the moment. Okay, we're seeing a huge spike right here, right? And whenever we see these huge spikes in the past, we see that the EPS beat ends up happening there as well. So just something to consider, not a big not super reliable, not 100%, but it is just something that you want to consider, right? And we've seen lots of economic surprises really this whole entire year. And more S&P companies have pre-released positive Q2 earnings than at any point since the post-pandemic bull market. That suggests a good financial reporting season, which starts later this week. Now, it actually earnings season already started last week. Okay, I've just been behind on a few videos. My son was just born last Sunday, and I had a bunch of stuff, ready to share with you guys, but I just haven't had the time. But if you take a look, Delta is one of these companies, right? They're posting record quarterly earnings, and they had record revenue and earnings for the second quarter. Based on strong international travel demand and cheaper fuel, boosted Delta's bottom line. They make the bulk of their money in the second and the third quarters, right? And so, this is that second quarter earnings that we're about to be getting. And just really, really interesting here, right? If you take a look at that chart, right, and we take a look at the positive pre-announcements, right? You have negative and positive pre-announcements. These have a really big impact on the market, actually. Okay, remember when Walmart came out ahead of time before earnings and basically said that they're going to have bad earnings? The stock collapsed, right? And then when earnings actually came out, the stock collapsed even more, even though they already gave that foreshadowing, right? And they gave that pre-announcement. So, this really does suggest a good financial reporting season, a good earnings season. And, it's going to be really interesting to see how that plays out, right? And a lot of people aren't expecting that. Now, 7 of the 11 sectors are expected to see earnings growth, improving this quarter versus the first quarter, right? And this is the S&P 500 sector's quarterly earnings growth year over year. This is from Bank of America. A lot of these charts right now are from Bank of America. All right. And we're seeing really, really good expectations here, basically, for the second half quarter or for Q2 earnings. And so it's going to be, really, really interesting to see what we get, right? We have some really big names kicking off this week. We have the bank starting it off on Friday, and it's going to be a roller coaster in the stock market. So I'm pretty excited. I'm very excited for earnings season. And we're going to see what really happens. But, a lot of people have been projecting, these terrible, terrible earnings in the market. And, a lot of the data is suggesting we might actually get better than expected earnings. Now, energy in specifics drove the entire downward revision since March, right? If you take a look at the change in S&P 500 2023 consensus net income since March 31st, and what we see here is that it is really a lot due to energy, right? Energy was negative 9% here, okay? It was pretty much all energy. You have materials, financials, staples, and healthcare, and then the rest was all positive here, okay? So really all of the this part right here is really good at summarizing it for you guys. If you take a look, right, and you have The S&P, it was negative 1%, but if you exclude energy, right, it's at 0%. And if you exclude energy and the financials, it's actually positive 1%. So energies and financials, mostly energy, really contributing to a lot of the downward revisions in earnings. When we take a look here, Q2 EPS is negative 2% in the last 3 months versus the 4% average. First quarter with a smaller cut in a year. Bottom up S&P 500 EPS revision by quarter in 3 months before reporting season. This is from 2000 to Q2 of 2023. Is what we're looking at here. All right, and you can see these revisions are down, right? So everybody's expecting really, really terrible earnings, basically, is kind of what it seems like in the market. And when you have those really bad expectations and you have all of this good economic data coming out, it's very possible that we could get a surprise, right? And a lot of people think that stocks have rallied so much, there's no way that stocks can continue to go up on earnings. But if a lot of bad earnings are expected right now and they aren't as bad, or maybe they're even a little bit good, then we could really see this stock market rally continue to go up even more, right? And that's just kind of what I want to highlight. Now, not every company out there is going to be, not everything is going to just go straight to the moon. But this is just some really good data to show you guys heading into the earnings season as it's just beginning. When you take a look at the S&P 500 quarterly earnings change from a year earlier, all right, the estimate is negative 7.2%. There's only a few times it's been negative like this, and now it's going to time. It's basically going to be time to see, right? Are all of these estimates and all of these negative estimates going to come true? Now, another big theme in the market, for most of the year was that it was basically there was no diversification of the gains, right? It was basically the Magnificent Seven, okay, really just leading all of the stock market gains. When you look back in May, okay, only 23% of stocks outperformed the S&P 500 in May, which was the lowest of any month in our data history since 1986 from Bank of America. Right. And you can see that here on this chart. But what we've seen is we've actually seen a lot of catching up in other stocks, right? And not just the big seven, the Magnificent Seven. Now we are starting to see a lot of other things, really catch up and, start to diversify the rally from just big tech. If we move forward, one other thing, right, because we've officially started a new bull market, via technical definition, and IPO activity is a really good measure to see if you're in a bull market as well. And you can see here during the bear market, there was really just, nothing, right? When you come to IPOs, there was just absolutely nothing in the market. In Q2 of 2023, already seen a significant increase. All right, $6.6 billion in proceeds when it comes to the IPOs. And again, this is just something that you see in a bull market, right? You're going to see IPO activity in a bull market and not these bear markets. And this is just kind of another sign via looking at IPOs that, we're basically in a bull market right now, and we're going to see, how this bull market proceeds. Now, something people have been talking a lot about is consumer credit, and the growth there is slowing. You have non-revolving lending drops for the first time since 2020 as rates climb, okay? And so you see the rates on credit cards are increasing, the rate on 5-year loans for new car purchases increasing, and we are seeing the change in consumer credit outstanding month over month is actually declining right now. Now, there's been lots of big inflation surprises, all right, and inflation has peaked and been coming down pretty nicely. All right, we've seen lots of big inflation surprises receding, and that's essentially what this chart is showing right here. You have China, you have the U.S. CPI, you have the Global Inflation Surprise Index and the U.S. Inflation Surprise Index. And it's really just been going down, down, down here, right? When you look at core personal consumption expenditures price index at a 3-month annualized rate, all right, we're seeing housing, which is a really, really big part of it, has finally started to drop, and core services. Okay, when you break down inflation and what's really been killing inflation or hurting us in standpoints of inflation has been that housing and has been those core services. And we're seeing those finally start to decline. All right, we're seeing core PCE start to decline here as well. All right, now core goods have started to uptick a little bit here. All right, but the main things are these that we're looking at, right? The core PCE, the core services, housing. Those have been some really big factors for inflation. Now we have deflationary online goods here as well. Okay, online prices have fallen for 10 consecutive months, dropping 2.6% in June. And this is the Adobe online inflation year over year. And this is the most in 3 years that it's dropped right here. So really, really significant stuff that we're seeing. And this is a large part of why the market is rallying too, is because we're finally starting to see that strong downtrend in inflation. Now the big question is, will the second half of the year really see an uptick in inflation? That's something that you have to be cautious of and consider. Given how much the market has already rallied, if we start to see inflation tick back up, that's going to be really troublesome. And we're potentially going to see the Fed do even more rate hikes than they already are planning. Now, this is just some more data just to show you guys that deflation. We're looking at the Manheim US used vehicle value index, and we can see we've had this nice drop here finally. Okay, very, very good to see. When you look at the drawdown, you're seeing a big drawdown right now in the used vehicle value index. This showed up in the most recent inflation report. And a lot of this data for July is going to show up in the next inflation report too as well. So finally we're starting to see this come down. That's been a big factor on inflation as well. Hopefully you guys enjoyed today's video. If you did, smash that like button and subscribe to the channel. I'm going to be doing a little bit divided videos like these. I'm actually going to be dropping more dedicated bond videos, okay, and really just kind of going over some of the main bond funds, right? We're going to look at TLT, LQD, HYG. We're going to look at TNX. All right, we're going to take a look at SPXB, the bond market ETF. I've also got a video coming soon on some of my sleeper AI stocks. Okay, so let me know if there's a stock out there or some stocks out there that you guys want me to cover related to AI that you think people aren't really paying attention to. A lot of people know the big names. They know Amazon, Microsoft, Google for AI. But there's a lot of other actually, solid companies that have AI implemented into their business or revolving around AI that a lot of people don't know about yet. The AI bubble is still forming. Right. The reason it's a bubble is because people don't know properly how to value what AI is going to bring. Okay. It's hard to put a valuation on it right now. So until then, people are going to keep speculating and keep speculatively investing into those until we see the true winners and which ones have real business models that are practical. And, the losers are going to be the ones where, when the bubble eventually pops, and who knows when that's going to pop, right? That could be very soon. That could be a year, that could be years out in the future. So let me know what AI stocks you guys would like me to cover. And if you guys want to see some technical analysis on your favorite bond ETFs, let me know what bond ETFs you would like me to cover. All right, you can actually watch that video right here and go over all of the bond ETFs that I'm looking at right now.